Hi and welcome to pallavijhastocklens. In this video, we will cover Q1 FY26 GDP numbers, the growth numbers that have come in. We'll try to see in detail. So for Q1 FY26, India's real GDP growth came in at 7.8%, which is highest in 5 quarters. And this is the quickest growing or the highest GDP growth after Jan to March 2024 quarter, wherein it had grown 8.4%. After that, this is the quarter in which it has shown such good growth of 7.8%. So if you see previous quarter's GDP growth, that was 7.4%. And if you want to compare for year over year, that is quarter 1 of FY25, it was 6.5%, whereas now it is 7.8%. So just like we have quarterly updates for companies' results, similarly we have GDP updates for every quarter, which then aggregates to annual or yearly GDP numbers. Okay, so this 7.8% real GDP growth has beaten estimates by a wider margin, and even with slow GDP growth, India retains the tag of being the world's fastest growing economy. This is important because this comes at a time when Trump has imposed additional tariffs for India's exports to the US. And what economists and analysts think is that if this US tariffs continues, it can impact India's GDP down by 30 to 90 basis points. That is less than 1% at max. But given US court's ruling as to Trump's tariff implementation is illegal, given US embassy in India is trying to mend relations with India, it looks unlikely that the said additional tariffs will continue. For the near term, it is a headache, but maybe after October or something, a major relief can come in, and therefore the GDP's growth pace will remain intact. So if you look at latest IMF projections, so it says that India is set to become the 4th largest economy by the end of FY26, and that India will also overtake Japan. In nominal terms, if you see, GDP has grown by 8.8%. Now, what is the difference between real GDP and nominal GDP? Okay, so 7.8% real GDP growth in Q1 of FY26 means that India's economy actually produces 7.8% more goods and services compared to Q1 last year in terms of volumes and not just higher prices. So, for example, last year 100 cars were produced. So this year 107 or 108 cars were produced. That is 7.8% increase. Okay. And what does nominal GDP mean? So nominal GDP growth numbers means that inflation numbers are included in it. So for example, last year this quarter, that is in Q1 quarter, 100 cars were produced and the price per car was rupees 10 lakh rupees. In Q1 this year, in quarter 1 of this year, the car's rate is rupees 11 lakh. Okay, so in this case, what you're seeing is that although same number of cars have been produced, the GDP value looks bigger because of increase in prices. Okay, so when inflation is included in GDP, it becomes nominal GDP, and when you see for GDP numbers without this inflation factor, that is real GDP. We are eliminating price inflation and seeing what is the actual production. Okay, and if you look at RBI's estimate for GDP numbers for the 4 quarters of FY26, it is 6.5%, 6.7%, 6.6%, and 6.3% for Q1, Q2, Q3, and Q4 respectively. And for Q1, the projected rate was 6.5%, and the actual numbers have come in at 7.8%, which is far exceeding expectations. So generally, RBI gives a precautionary rate, and the actual number almost always comes beyond expectations. The gross value added growth is 7.6%, whereas nominal GVA grew by 8.8%. Now, what is GVA and how it is different from GDP? Okay, that is something we'll see. So, first, what is GVA? So, gross value added means the value of all goods and services produced in the economy minus total cost of inputs that is used to produce them. Okay, it's like how much value different sectors are actually adding to the economy. Example, there's agricultural sector, manufacturing sector, industrial sector, services sector. So how much value each of these sectors are adding to the economy. For example, supposing there's a biscuit factory, it buys wheat worth rupees 10 and it makes biscuits worth rupees 15. So what is value added? It is the value of all goods and services that is produced minus the cost of inputs used to produce them. Therefore, the value added is 15 rupees. That is, it makes it makes this case worth rupees 15 minus the cost of input used to produce such biscuits, which is rupees 10. Therefore, 15 minus 3 equal to rupees 5, which is the GVA. Okay, so GVA growth of 7.6% means what? The economy's output after adjusting for inflation grew 7.6% compared to last year. And what does nominal GVA growth means? Without adjusting for inflation factor is nominal GVA, similar to nominal GDP. Alright, so without adjusting for inflation, the economy's output grew 8.8%. Now, this difference between nominal GVA and real GVA growth, which is 8.8% minus 7.6%, is 1.2%, which is basically the impact of inflation. So now you might have a doubt as to what is the difference between GVA and GDP. What is the difference between gross value added and gross domestic product? Okay. So gross value added, it focuses on how much value different sectors of the economy is contributing. And what is GDP? It is gross value add plus taxes on products minus the subsidies on products. So GDP is a broader measure because it includes government taxes and subsidies on products as well. To simplify it better, as to you might think which is better, when what to use. When should you use GVA? When should you use GDP? Okay. So use gross value add when you want to see which sectors, how much is it contributing as a value addition to the economy. It gives a clearer picture of sectoral performance. Okay, for example, you have agricultural sector, manufacturing sector, services sector. So how much each contribution is contributing to value addition to the economy individually. Okay, that is gross value added. And you can use GDP when you want to see the overall size of the economy. That is what's available for spending, what's available for investing, or when you want to compare it with other countries. That is when you will use GDP. So gross value added or GVA is that you're seeing through a sector performance lens. And GVA growth gives you a more accurate measure of underlying economic activity because it gives you the numbers, how much value addition each sector has made to the economy. Whereas GDP is like economy's headline number, which can be used to compare globally. So in simple terms, if you're going to see gross value add is like checking how each player has contributed in a cricket match. For example, how much runs have they made, how much wickets have they taken. That is each individual player. How a player has done fielding, you measuring that or you're evaluating that is gross value added. Whereas if you're checking the team's final score or team's overall performance, now that is GDP. So now we'll see what are the reasons for the surge in Q1 GDP numbers for FY26. So one reason is the export front loading. Okay, so what happens is, since the Trump tariff on India's exports were about to come into effect from 27th of August 2025, India's export to the US saw an acceleration of exports. Why? Because exporters didn't want to pay the additional tariff that was to become applicable from 27th August, and therefore there was a rush to export coal as soon as possible before such date so that the previous tariff rates are applicable. So because of which what happened is there was surge in export numbers that got translated to GDP growth for this quarter. For April alone, if you see, this accelerated export growth rate was 5.9%. Okay, so this was one reason because of which GDP has grown. The second factor, if you see why this surge in GDP growth number, is because of government's Capex spending. So in April to June 2025, government's gross capital expenditure, it raised to 2.8 lakh crores, which is surge of 52% year over year. Imagine more than 50% the government spent as capital expenditure for this quarter. Okay, and if you see the previous quarter, that is Q4 FY25, government's Capex spending was 33.4% growth. And if you're going to see for Q1 FY24, that is to see there was 35% contraction. Now, why there was this contraction? Because government stopped spending in April to June 2024 because of Lok Sabha elections during that time. Because of that, this surge looks all the more. Okay, where there was contraction, now it is like 52% year on year higher spend. So that is why it looks the difference is very high. It looks very high. Similarly, if you see new project announcement, so that has nearly doubled, rupees 5.8 lakh crore in Q1 FY26. So double the amount of new project announcements, even that has translated to GDP growth. And if you look at project completions, that is actual completion of infrastructure work, that surged to 2.3 lakh crore this year. And this was 70,000 crore rupees last year. So almost 3 times increase in project completions. This has also translated to GDP growth. So project completion means that it's not just plans but actual work is getting done, which puts money into the economy quickly. So this front loading of public investments has not only boosted GDP figure, but it has also contributed meaningful additions to GVA numbers, GVA growth. Okay, so GVA, why? Because as we've discussed, it is a more accurate measure of underlying economic activity. So GVA has grown by 7.6% in Q1 FY26 versus 6.8% in Q1 FY25. So now we'll see what is front loading. So normally what happens is government has a yearly budget for the expenditure that it's going to make throughout the year. For example, 10 lakh crore rupees for full year period. Now, instead of spreading this evenly across 12 months, government sometimes spends a big chunk earlier in the year, say in the first 3 to 4 months. Now, this is called as front loading. That is spending more in the beginning of the year than to wait and spend evenly throughout the year. Government's front load expenditure has added on to the GDP growth numbers. Okay, so also when government front loads Capex, government does it so that it benefits. That happens is like people get jobs, demand for raw materials increases, and there is expenditure on cement, steel, machinery. Such industries benefit from it, and expenses for these raw materials and all, it starts flowing earlier in the year and it multiplies throughout this economy. Okay, so that is the reason government makes front load expenditure, which has also added to the gross domestic product growth numbers. So if at all there is a question as to what does government spending has to do with GDP growth numbers, so see, GDP, that is gross domestic product, it measures all spending in the economy, whether such spending is by consumers, businesses or the government. So when the government spends more on projects, GDP grows up automatically because that spending is counted directly. And what is GVA, that is gross value added? It looks at how much value industries are adding. GVA, that is gross value added. For example, construction industry, manufacturing industry, services industry, how much value are individual industries adding to the economy. Okay, that is gross value added. So government spending, it helps gross value added also. How? Because if the government spends on a new highway, if a government starts up a new highway, so construction companies earn, steel companies earn, cement companies on, okay, cement and steel demand rises, workers get paid, and so on. So in Q1 FY26, the GDP grew 7.8% and gross value added grew 7.6%. So both show that government spending was a strong booster to bring in these numbers. Okay, and the effect will also multiply within the economy. And in Q1 FY26, higher government investment in infrastructure, it has boosted both GDP and GVA. And that makes the economy look stronger than the last year because government was not able to spend because of Lok Sabha elections. So coming to services sector, it has been the star performer. Services sector, if you see, it has indeed contributed very strongly to Q1 FY26 GDP growth, that is of 7.8%, and it has also contributed substantially to GVA growth, that is of 7.6%. So if you see, services sector forms 53% of India's GDP, and in Q1 FY26, services sector has expanded by, that is, it has shown a growth of 9.3%, which is strongest in 2-year period. And if you compare it with the previous quarter, that is Q4 of FY25, you'll see that service sector has grown by 7.3%. Whereas if you have to compare year on year, that is Q1 of FY25, the services sector grew by 6.8%. So if you see, both in the preceding quarter and in the Q1 quarter last year, compared to both of these, this particular quarter has shown very good growth. So in this quarter, government services has expanded by 9.8%, which is 12 quarters high. Financial services has increased or grew by 8.6%. And trade, hotel, transport, communication services, this has expanded by 9.5%. And if you see in terms of gross value added for this quarter, financial services has expanded by 9.5%, whereas in the preceding quarter, that is Q4 of FY25, it was a growth of 7.8%. And if you see public administration services, it has grown by 9.7%, whereas in the preceding quarter, it was a growth of 8.7%. Agriculture sector, if you see, it is 3.7% growth, whereas in the preceding quarter, it was 5.4% growth. And if you're going to compare it with Q1 of last year, it grew just 1.5% in Q1 last year. So you see, compared to last year's first quarter, it has grown substantially, whereas compared to previous quarter, the growth has declined. Now, Agricultural sector has reasonably performed well because of good monsoons. If you're going to see manufacturing sector in terms of GVA, it has grown by 7.7% this quarter. In the preceding quarter, it grew by 4.8%. And in Q1 last year, it grew by 7.6%. So compared to previous quarter, it has performed substantially well. Whereas when you compare it with Q1 last year, it is almost on the same lines. Mining sector has significantly declined. In the preceding quarter, it grew by 2.5%, whereas in this quarter, it has declined by 3.1%. So construction sector, it has expanded by or grew by 7.6%, whereas in the preceding quarter, that is Q4 of previous year, it grew by 10.8%. Electricity and public utilities, if you see, it has grown very marginally, that is 0.5%, whereas it grew substantially in the preceding quarter, that is 5.4% growth. From this data, what you'll understand is substantial expansion or substantial growth in services sector for this quarter has been able to take care of or offset the stagnant growth or slow growth, subdued growth or decline in growth in other sectors. So that is also one good thing that services sector expansion has taken care of. Also for this quarter, if you're going to see export growth, so exports have grown by 6.3% in this quarter, versus 8.3% year over year. And private consumption. Now this is important to note that private consumption forms around 57% of GDP. And this has grown by 7% in this quarter, which is highest in 3 quarters. So investment growth, if you see, it has expanded or grown by 7.8% this quarter. This is majorly because of government's front-load capital expenditure. And investment to GDP ratio, if you see, it is 34.6%, which is a 3-year high. What does investment to GDP ratio indicate? So it is the percentage of a country's GDP that is spent on investment in capital, like buildings, machinery, infrastructure, etc. If the investment to GDP ratio is high, it means that there is strong economic activity and there is strong potential of future growth. Why? Because when government and businesses are investing in assets that will enhance future productivity, enhance future production, enhance economic output, then there'll be increase in productivity and expanded capacity, which will finally or eventually lead to higher GDP growth in the future. Okay, and if there is low investment to GDP ratio, what would that mean? That would indicate that there are less investments in productive assets. And the other factor is that low inflation, okay, because India's retail inflation is at 8-year low. So this is also one factor that translated into good GDP growth numbers. Now, what is retail inflation? That is how far prices of goods and services are rising for consumers. Real GDP means what? It means what is the growth of the economy after adjusting for inflation. If the GDP numbers are not adjusted for inflation, that is nominal GDP. In case inflation is low, which is the case with India, because it is retail inflation is at 8-year low. So what does that mean? It means that consumers' purchasing power stays strong and that companies, they don't need to raise prices too much. But if the demand is strong, they have the ability to raise prices without losing customers because they can enjoy the pricing power. And this gap between the nominal GDP and real GDP becomes smaller and therefore it makes real growth look better.